exam review recording. So, exam 2, next class, we're covering chapters 1 through 12. The makeup of the exam. Maybe I should not chapter. You didn't want the true false, so no more true false questions. You will have 14 short answers. One of those will be the Barron's Review, just like you've had before, where you read any Barron's article of your choice, maybe related, hopefully related to investments. You summarize it. You provide the practical application. What's the takeaway for that? With the short answer, there will also be one where you can just show me you learned something. So something that wasn't asked on the exam that you learned. What's something that you can show me that you have learned? You can't just say, I learned about X without elaborating on that. You have to demonstrate that you've actually learned whatever that concept is you're claiming to have learned. Calculations. I'm going to be a little tricky here. There's 4 calculations, but some will be multiple calculations in one question. We'll go over some of what those will be, and then just 5 multiple choice. Cool. All right. So, big questions. What are we doing in investments? Why do we do it? We do it to make money. So the goal is to meet our clients' goals, given their time horizon, their objectives, whatever they've got, and matching their risk tolerance to that investment strategy. The risk return, the idea behind that is the greater risk that we take on, the greater the return that we expect. Otherwise, we don't want to take on that additional risk. And we've seen some of our calculations on a risk-adjusted basis. Just because you got a higher return, you got 10% and the market got 8% on a risk-adjusted basis, the market might have actually beat you, or the other way around. The big thing you're going to learn in this class, your big takeaway, is to be able to create a diversified portfolio, taking into account that risk tolerance, risk capacity, the different types of accounts that we can invest in. So I want to diversify not just the different investments themselves, but the different types of accounts I've got. There's tax diversification. We've got our idea of the Roth investments growing tax-free. If we think that's going to be the highest reward, we want those to be our riskier investments because we're not paying taxes afterwards. But we don't know what's going to happen to taxes in the future. So some tax diversification as well. We want some tax deferred, some tax-free growth, and then our taxable accounts. So a mix of them and thinking of what investments would be more appropriate in which type of account. And feel free to interrupt at any time. Okay, so we have our cute bear, and we've got bulls and bears. What's going on in the market? How do we see the investments happening long term? So to get into those markets, we are accepting that we're going to take on some sort of risk, and we can decide how we want to interact with the market. Do you want to do it on your own through your Vanguard account, through your Fidelity account, Schwab account, wherever you've got it, and then put in the order, your own research, figuring out what you want. If we think the market's going to do well, we're going long on the market, we think we're going to get a return. If we're bears, we might be going short, betting on a company to fail. And we can get into options later in the semester where we'll look at some strategies of taking on that additional risk for hopefully more reward. With our orders in there, even if you're doing it yourself, you have the idea of, I could buy at whatever the market price is. And we saw how market price is fluctuating a little bit throughout the day. So when I place the order and when it comes through, the price is whatever the market was selling at that specific time. Or I could say, I don't want to pay that much. I want to buy this stock, but I don't think it's worth $52.78. I'm willing to pay $52.50 or $51 or whatever it is that you're willing to pay. I can say no more than this price. I want to buy 100 shares at this price. If it doesn't drop to this price, I don't want to buy it. And I can make that in effect for just the day. And at the end, it disappears. I'll have to go back in and manually make another order. Or I can say this is good until I cancel it. So I'd have to manually go in and cancel. With the same idea in selling, I can say I'm not willing to sell the stock unless it's for at least this price. If somebody tries to buy it for less, if the market price is less than that, the sale doesn't happen. Same idea there. I can limit how long this lasts, good till the end of the day, good till I cancel it. With our margin account, that was where we were magnifying risk. So when we buy on margin, we are in effect buying without dollars that we don't own. The institution, Vanguard Fidelity, is going to make up the remaining amount. We had our two numbers there, 50% and 25. So in order to have the margin account, in order to invest on margin, I have to have 50% of whatever the investment is. So if it's a $100,000 investment, $50,000 is coming from me, the other 50 is coming from Vanguard or whoever. We buy into this, and if it drops, there'll be a maintenance call when it drops below 25%. So I may have to put some more money in. This is magnifying risk, and we're leveraging ourselves. If it loses money, I have to pay back Vanguard Fidelity, whoever I'm doing it through. If it does well, great. My other dollars were out investing elsewhere, paying bills, whatever it was that I was doing with those dollars, or maybe I didn't have them at all, but I was still able to get a return as if I had. Costs, when we're just doing it on our own, we may be looking at tax costs, maybe looking at transaction costs. So taxes on our investments, if we have profit and we sold it, so not just paper profit where the value went up, I'm responsible for the taxes on that. We go into mutual funds, we see they're a pass-through entity, I'm responsible for the taxes on whatever's happening in the account, even though I may not necessarily be making the decisions on what happens in the account. Dividends almost always will be long-term capital gain. I always saw our exceptions with foreign stock and stuff that we had owned for a very short period of time, something we just bought. That would be built into the price of the stock when I bought it. Other costs we might incur would be, for mutual funds, the fees that mutual funds charge. We'll get into that load and their 12b1 advertising fees in a future chapter. With the transaction costs, those will be lower if I do it myself, more if I am paying somebody for the advice. They're doing it for me. So if you're a financial planner and you are investing on behalf of a client, they're paying you for that service. And you might be outsourcing your investment portfolios. Somebody is figuring out, okay, this is an aggressive one, this is a more conservative one, and you match up the clients to that portfolio that they've created, that group of investments that's going to work for your client. So that's an additional cost that would be passed on to the client. If you are looking at this idea of efficient markets, we can't consistently beat the market, so we have to provide value for the clients beyond just not quite hitting the market, because they're paying you and they're potentially paying that third-party investment group. Maybe you have it in-house, but more people to pay. Different parties in the market. We had the market maker. We saw that idea of the spread, or the difference between the bid and the ask. The bigger that spread, the more money that they are making. So they make their money by paying one price for it and selling it to you at another. We have the SEC looking at the idea of transparency. So we had the different rules. So we had 1933 IPOs. These initial public offerings had to create that shelf registration, had to supply all of the financial information that an investor would need to know in order to decide whether or not to make this investment. 34, they said, okay, well, all existing companies, all publicly traded companies have to post this information. And we have access to their annual financial statements on EDGAR, their 10K, their quarterly statements. If a executive buys or sells a large chunk of the company stock that they're working for. And we have some trust in those financials because after Enron, we got the Sarbanes-Oxley Act, where not only do those CEOs, CFOs have to sign off on the financial audit statements, we have an external party coming in to conduct those financials. So accounting firms, Big 4, Big 5, whatever, will audit the big companies, and now we can trust that those numbers are what they say they are. I just talked about that regulation. With the initial public offering, we had two ways that we could go public. Now, I'm assuming we're working through a financial intermediary. That financial intermediary is going to charge for their services, and they can say, I'm going to do my best effort to get your company sold at this price that we have determined for the number of shares that we've determined. So that intermediary is working together with the company to figure out what a proper price for this is, how many shares are going to go out. Guaranteed, that financial intermediary is saying, okay, I'm not just going to do my best to sell it to the public, I am also going to guarantee that all these shares are sold. If the public doesn't buy all these shares, I will buy those remaining ones. I mentioned the self-registration earlier. All IPOs have to have that information up there. And do you remember what the issue was that we saw with Theranos? The financials were great. That was the information that the buying public might need to know. But what was the flaw? Yeah, their product didn't work. Elizabeth Holmes was making it up. And we saw, what was it, her grandpa or uncle or something? Was it Enron? But the actual product itself didn't do what they said it could do. And that would show up in the financials. The financials were great. They had CVS, Walgreens, all these other places that already had orders in, wanted to carry the product. The dollars looked good. The demand was there. The product just didn't exist. Okay, time value of money was our chapter 3, where we busted out our calculators and started looking at this idea that if I have $1 now, it's worth more than that same dollar in the future. Last class, we looked at how $1 when I was born, I would need $3.84 to have the same purchasing power. So purchasing power inflation is eroded over time. It's going to cost me more, but I can put those dollars to work for me, and we can calculate how that's going to pay off. With all calculations that you do, be sure that you write out your information. Last exam, I was able to give you points, partial credit for work that maybe was set up mostly correctly. Maybe you swapped future value and present value, or you didn't put something in as negative, but other than that, it was correct. So our in is the time. So I would write out each of the inputs and show me what you put in there, and then give me the answer. If you just put an answer and it's wrong, I give you none of those points. If you put an answer and show your work, I can give you some credit for having set it up correctly. So in the time period, the mistake some made was not converting, maybe from annual to 12 times a year. So if we have these monthly payments, we can shift periods per year to 12, and that handles our IY automatically in the calculator, but you still have to make the adjustment for the N. So if it's over 5 years, and we're doing it monthly, 5 times 12, 60, N would equal 60, but my interest rate, if I've set it to 12 periods per year, I don't have to make an adjustment there. PV and FV, present value and future value, they have to be opposite for the calculator to work, and then our payment has to match up with one of those. And thinking about that conceptually, if I'm taking it out of my pocket to add somewhere, that is negative, it's going away, even though maybe it's my own account. Also, that same idea with understanding the logic, I may not put in the correct conceptual negative, but I'm gonna line things up correctly. And if I had a 10% return and my future value calculator says it's negative, I know it's a positive amount. So understanding logically what's going on. If you get a number that doesn't make sense, in counseling there was a car payment, and some of you were doing it once a year, and it wouldn't make sense to have paid that much total for the car. Annuity and annuity due. The annuity is this steady stream of payments. You can buy it from a insurance company. We had different ways that we could set that up. We had the SPIA, the single premium immediate annuity, where I gave them a chunk of money today and they immediately started paying me that stream of payments. That would be in begin mode because it's beginning now at the beginning of the period. So if I say annuity due or begin in a question, beginning this month, beginning at the start of the year, whenever, you need to be in begin mode. Default will be in mode for these calculations, but make sure you're in the correct mode there. Other types of modifications we can make to an annuity, we can put in that COLA, the cost of living adjustment. It's going to cost me more because it's going to cost the insurance company more to make that stream of payments to me. I could say I wanted to guarantee a certain amount of payments, so if I get hit by a bus next month, my wife can continue to receive payments. There will be more dollars that come out of it to a guaranteed minimum. I could put it, I want to receive this amount for my life, and after that it switches to a lower amount for spouse or for whoever. No restriction on who I make that second person to. So calculations there. I'll probably do something with an investment where maybe you compare two. I've seen that before. What does investment A and investment B provide as far as the return goes, or what will the return be? What's the total? Any one of those time value of money inputs is fair game. As long as you can afford, you could solve for the fifth. If I don't provide one, it's probably because it's zero. Okay, financial planning, taxes. Talked a minute ago about the different ways we can deal with tax and investments. I'll go into that again. So objectives and goals. I want to find out what my client wants to do. Do they want to retire in 20 years, in 30 years? And when they retire, if they do want to retire, how do they want to live in retirement? Do they want to travel the U.S. in an RV? Do they want to downsize and move to Florida? Do they want to be closer to grandkids, wherever they might be? Do they want to travel the world? What's their style, what's their standard of living going to be in retirement? So knowing that, we can project for some costs, and we can figure out how to save for that. If they want to buy a car in 4 years, or they want to buy a new car every 5 years, we figure out how to do that. In order to help them, I need to know all their financials. So just like in counseling, we had our 3 goals, or our 3 things that we needed to know. What's their issue? So here, their goals, and then their dollars. I wanted the balance sheet net worth, so I know what assets and liabilities they have right now. That tells me what accounts they have access to. And if maybe they don't have a taxable account, maybe we can open one for them. If they don't have an IRA, maybe we open one for them. If they're not participating, but they have access to a retirement plan, a defined contribution plan through their employer, we learn about how that's going to work. Does it give a match? Let's take advantage of that free money where the employer is matching it instead of going into some other source, taxable account or IRA. Cash flows, I want to know what they are spending, where their dollars are going. I'm not necessarily going to make judgments on that, but understanding what their inflows and outflows are will help me figure out, well, what can we potentially change to plan for this retirement they want of traveling the U.S. in an RV. They want to see every national park. Diversification, hit that throughout the semester, figuring out how we reduce our clients' risk and get them to the objectives they want. A diversified portfolio with multiple things in there. And you'll see in a moment the graph or the chart that I had y'all draw last time. You'll need to know the primes, the things that are part of the systematic risk, and the elements of unsystematic risk, the business and financial. Tax shelters, we've gone into those different types of accounts. We'll look at bonds later in the semester, municipal bonds in particular, where we have some differences in how they're taxed, if at all. This will also make a difference in the state that you live in. So if there's a state income tax, a bond that's not going into taxes is less valuable because we're not saving as much and the tax wasn't there. It's going to be more valuable. Did it just stop?
I think so, yeah. I looked over and it like down and stopped.
Okay. Hopefully it keeps going. So I'll go over active and passive. That's probably, yes.
Are you going to post this on the Facebook or on the YouTube channel?
YouTube. I can't put it on Facebook, I don't think. So I'm not people interested in the Facebook page and they change their rules. So yeah, I'll put it up on the YouTube channel that I made for our last one. Active versus passive. Let's go over both again in case it wasn't on the recording. Active, they're actively going out and deciding what to put in the mutual fund, what to take out, so buying and selling, and they've got all these experts figuring out what to buy and sell. It's going to cost more. The passive are matching an index, an existing index, the S&P 500, the Wilshire, the Titans, the whatever I'm trying to get into. We've got different sectors, we've got bond index funds, we have very, very low cost in those, if at all, because they are just mimicking what's already out there. So Fidelity started offering these for free and other companies followed suit. They want to get you in the door and buying on other things so they make money some other way from you. With the index funds, it's very easy for them to figure out what to put in it because the index is already out there. They just automatically probably have a computer program that buys and sells according to whatever's happening on that index. Anyway, so here's that chart. I'll probably ask you to recreate this again like I did last time. This is the big thing that you're taking away from the class, the ability to create the diversified portfolio. So 12 to 15 different companies, so different types of businesses with different types of financials as far as how much they have leveraged themselves, what kind of debt they have. We are creating a reduction in unsystematic risk by not putting all our eggs in one basket, by not investing everything in Pepsi and Coca-Cola, so actually different companies. Systematic risk, we had our primes, and we can't.
It was going in the next one because I looked over and it had that red because last recording.
Yeah, last time I looked over it looked like that. But then she just...
Do you have like low storage?
I don't know. I don't think so. I deleted the last one.
We'll,
That was
we'll
a-
just let
that
you
was
know
a-
if it like
Yeah.
goes off.
Do you want to be in charge of
Yes.
keeping it? Maybe touch the screen every once in a while. Okay, so know those primes ended on the exchange and the sovereign rate risk. Do you want me to go into what each one of those does?
You want us to know the definitions for this test, right? Is that what you said last time or no?
Let's hold it for one more. Be able to list all of them. Know the business financial, be able to explain those. Primes, I'll keep it one more time where you just need to know what those elements are. So how to diversify, we have our different types of companies. We hit on those business and financial. We have this idea of standard deviation and beta. If we get into our calculations, our alpha, trainer, sharp. Trainer and sharp are looking at, if it's trainer, I I assume I have a well-diversified portfolio. If it's Sharp, I'm assuming I don't. And I remember Sharp starts with an S. S, standard deviation, would be the denominator. Arbitrage was that day trading idea where you're pretty much going to lose money on transaction costs, on taxation issues. Where did I say you could create the sandbox to play? It avoids the taxation issue. What's that?
Alright.
Yeah, in a Roth account where maybe we partition out a section, we create a separate Roth IRA just for the client to play with options, to play with futures, to try arbitrage, whatever. They may still be paying some transaction costs depending on how frequently they do it, paying Vanguard or Fidelity or whoever, but they might also be able to get that at a lower cost, and it's a small part of the portfolio. So we want to think overall, all the investments were on the right track. Here's a play thing for a client that wants to play, and maybe it does great, maybe it doesn't, but it's safer there. It's safer to give them that freedom than to try to go big on it. Okay, with the mutual funds, we looked at the idea of sort of two big types: closed end, where buying directly from the investment company and they can continue to create more shares. Advantages of mutual funds: we have that automatic diversification, or more diversification than if I were to just buy some stocks myself. If I buy an S&P 500 index fund, I've got exposure to the largest companies in the U.S. If I buy an index fund in something like the technology sector, healthcare, I'm adding more and more companies. If one of them goes down within that mutual fund, cool, there's 92 others or 128 others, however many are in the mutual fund. I've got that professional management where I'm not the one that has to ensure that this is rebalanced regularly to continue to meet whatever if it's an index fund, to continue to match that index. If it is actively managed, to make the determination of buying or selling within that fund, what companies to keep or not. And then finally, the record keeping. So I know what things have been purchased when, and if I have to do taxes later, it's already done for me. Fidelity has set up all that documentation. I just pull it out and I see what's sold and what's not. Tax through entities, they are passing the taxes on to me. So when we looked on Fidelity's website, on Vanguard's website, we saw that they would list, hey, here's our performance for the past year, past 3 years, past 5 years, since inception. And they would give a number. That number is not what your client's going to get. They are not including any of the taxes because that's passed on to you. So if it has a whatever return, 10% return over the past 3 years, all of their clients didn't get exactly 10% growth in that stuff. They got a little bit less because they had to pay some fees and they had to pay some taxes. So the load of the ABCs of fees, we have the front end load, back end load. Back ends, I may have to pay a little bit more if I don't hold it very long. Sometimes that can those, the different sectors, they can invest in anything. We had the actively managed target date retirement funds, and then we had others where instead of picking mutual funds that cost more, they picked index funds and created a similar mix. A target date fund, they give you all the information. Any mutual fund, they're going to show you what they're investing in, the percentage of it, the different companies, and you can recreate that on your own. It just takes work. So that's why we're paying them, because it takes work to put that together. For the target date retirement funds, you could go in once a year and change it to those index ones, and you would pay a little bit less in cost. If you choose the target date fund that is actively managed, it costs you more. I think we saw it was almost double. We went in there paying like 70 cents per $1,000 in it in one, and like 3 cents in the other, or 7 cents and 3 cents. investor pays the taxes. Here's some more math, and like I said, I would have multiple calculations in one of those questions. I might give you two funds. Maybe one's the market and one is your client's investment portfolio, or maybe you've got two clients, each with an investment portfolio, and you are going to compare the two. Beta of the market, I wouldn't give you. That's always one. And I talked about how it's important to match the market to the makeup of this portfolio. So I wouldn't want to match the S&P 500 as the market and call that one compared to something that's super aggressive, investing in small cap stocks. You want to match it appropriately. The beta will be one, so I won't give that to you. For the market, for the portfolio, I give you the beta of the portfolio. Higher than one, it's riskier than the market. Less than one, it's less risky than the market. If it's also one, it's an index fund that's copying that exact market. So the alpha of the portfolio, if it is positive, we've outperformed the market. Going into the math of that, we've got the return of the portfolio. So what I got minus what's the market doing, what's the risk-free rate doing, and then the risk that I took on, the beta of the portfolio. So risk-free rate was that 6-month T-bill. I'll give you that. You have the Excel file to do as many infinite calculations as you want. Just change the numbers and see if you can do it on your calculator. So the risk-free rate would be given. I should have been able to get that if I invested. I could have just put it all in this risk-free rate. Plus the combination. We're going to do order of operations here. So first thing you would do, return to the market minus the risk-free rate, then multiply by beta of portfolio, how much risk that I took on. Add that to the risk-free rate, and did the portfolio beat all of that? With Trainer and Sharp, now I need a comparison. So if I gave you two companies, you have two different alphas that you're comparing, but really all I would need to know is if I'm comparing to the market. If this is positive, awesome, thumbs up. With Trainer and Sharp, you need two calculations. You need to do it for both of the portfolios, or the portfolio and the market. However many I'm doing, I need to be able to compare them against each other. If I just do one, the number is meaningless. We're looking at a simple calculation, and I'll give you the formulas on the exam, they just won't be labeled. Trainer, I think that this is a well-diversified portfolio. I'm making that assumption. I can look at it, we can figure out how diversified it is, and if we don't think it's diversified, we use Sharp, and we change our denominator to standard deviation. Other than that, the calculation is the same. The return of the portfolio minus the risk-free rate, and then when we do our comparison, return of portfolio 2, and then the beta of the portfolio 2, or standard deviation of portfolio 2. So make sure that you aren't using the same beta on both. You're not using the same standard deviation on both. So those will switch. Discount or premium, we saw that net asset value on our previous slide. If they're charging me less, I'm getting it at a discount. If they're charging me more, I'm paying a premium. And I might want to pay more because maybe I don't have access to this market otherwise. Maybe individual investors can't go into this country, but Big Schwab can get in there and create this mutual fund. And I think it's worth it because it's going to grow enough. REITs, or real estate investment, where we can either look at specific properties or the mortgages on the properties. We saw our video with, who was that guy? The chef, Anthony Bourdain. We talked about how they basically shoved all the leftover fish and stuff into one big stew and made it a new dish, where really it was bad fish. So we saw with the recession, housing recession, where this idea of tranches came in and people were saying, okay, well, if I got a bunch of C-grade mortgages and I put them all together, now it's more diversified because there's more of them, when really it was just all high-risk people that maybe weren't going to pay their mortgage back. Equity would be investing specifically into, could be residential or commercial properties, and then you would be basically pay their rents. ETFs, exchange traded funds, where we are behaving more like stock. And it happens at the end of the day or the end of the next business day. I'm able to do it immediately like I'd be able to do with a stock. Most mutual funds you see now are going to be exchange traded funds. Hedge funds and private equity funds are going to have a more limited audience. You have to qualify in order to get in. They're going to be higher risk, and there may be, like with our margin account, a capital call. So they're going to come to you and say, okay, in order to even invest, we are going to require you to put up $2 million, and you have to show that you have investable assets of this amount. And we're going to come to you in the next 6 months, and you're going to have to come up with another $1 million within a week. So it's harder to get in, and you're going to have that additional cost. These are going to be riskier. They may look at something very specific. They're not going to share as much of their strategy with you or with the general public. We talked about our different types of stock, common, that pretty much everybody's getting. They got the right to vote. There's going to be bylaws that set out whatever the company does. A company can be chartered in any or incorporated in any state they choose. With my one share, I have the right to ownership. Common stock might be owned in your mutual fund, but the mutual fund is the one voting those shares. You don't own the share itself, you own a piece of the mutual fund. They're buying and selling, making whatever decisions, and voting in their best interest, which for the most part will combine with yours. They're trying to make money, you're trying to make money. Preferred stock, now we had potentially the right to demand a dividend, or if they fall behind, catch us up, whatever was in arrearage. With our votes of the common stock, the bylaws would spell out whether I was able to combine all of, like, let's say we've got 7 board members. So I've got 7 votes for each share that I own. Would I be able to potentially put it all on chair 1? So I really want Susie to be on the board, so I can put all my votes towards Susie and not even vote on the remaining 6. Recognize still that I'm going to have a lot of stock for this to be an advantage to me, to be able to put whoever I want on the board, because most of the stock in the market is owned in mutual funds, so those big companies are the ones that are making whatever votes they want with the shares that they own individually. Dividends are paid out by the company or not. We saw Hershey's had that history of regularly giving out dividends, while other companies may not do it at all one year, or may decide to give out more because they've got more cash on hand. You tend to get more dividends from companies that are doing well. They've got the cash reserves, so they're able to do it. And we're looking at how much did they earn and how much did they pay out. So payout ratio or retention ratio are flip sides of the same coin. How much do they pay out and how much did they retain? If they pay out in cash, I'm responsible for the tax on that. And this is true even if it's in the mutual fund. It's probably long-term capital gains. We gave the exception earlier, it was a foreign company or I hadn't owned the stock very long. Otherwise, I'm responsible for paying tax on that. And I may set up my account to automatically reinvest. So DRIP, dividend reinvestment plan, I can set that within my account online and not have to worry about it, where they just automatically reinvest those dividends in whatever the company was or the mutual fund. If it's directly through a company, I own the stock and it pays a dividend, and I've elected to do the dividend reinvestment plan. Assuming the company is allowing that, that can cut my costs as well if they're doing it. If they pay out in stock, or have a stock split. Those are not taxable events because I don't have anything that I can go to the grocery store with and buy groceries. So I need to actually be 10 for 1, 5 for 1, or go the other way, 1 for 3. So they could expand the number of shares they've got. It doesn't change my position. If I had 10 shares and they do a 2 for 1, I now have 20 shares and worth half the value each. But my dollar amount invested, my setup is the same. So it's not a taxable event, it's just me as a company saying I need to combine these. I want to go 1 for 3 so that I meet a bare minimum dollar amount. So for every 3 shares, I'm going to combine that into 1, and now it's 3 times the price of what it was, so I can be listed on an exchange. Or maybe I am doing a stock split because I want the price to be lower so more people are able to afford a single share of the stock. We had our ratios. We went on Edgar and we did it for DraftKings, where we looked at how much money could they get their hands on cash quickly. So we had liquidity, we had the quick, and where they included the inventory, whatever things they might have to sell to convert to cash. Activity, how quickly something flows through a company. Profitability, are they making money? We saw our gross, operating, and net. Gross being the largest, net being the smallest. Leverage, how much debt do they have? And coverage, do they have the ability to pay back that debt? You want to calculate these on this exam, know what each one of them does. So I'll probably ask what are these 5 ratios, and you'll have to write out liquidity is how quickly can I get cash? Activity, how quickly do things flow through the company? Profitability, are they making money? Leverage, what kind of debt do they have? And coverage, can they pay that debt back? So know what each of those are. Go lightest on chapter 9. We don't have a crystal ball, so a lot of those calculations we were guessing, we were projecting into the future. We saw the financial statements, that's where we created our ratios in Edgar, pulling that money away. With our expected return, same exact calculation for actual return, it's just with actual, I'm looking at what has already happened, what dividends were paid out, what was the price I purchased this for, and what was the price I sold it for. So the change in the value of the stock goes up, that was my return, plus whatever dividends I received while I was holding it. Efficient market again, talked about that. Okay, so we saw our alpha trainer chart that looked at on a risk-adjusted basis, what return did I get? Looking at what we've got, we had sort of 3 different ways that we could look at our returns: price weighted, value weighted, and geometric average. Price weighted, I have this $10 share, $20 share, average 15. Value weighted, now I'm taking into account how many shares of each I owned. So you have that, I had $10 shares, I had 1 million of those, multiply that to get that value. And then I had the $20 shares, but I only had 8 of those. So multiply that, and then you get the price weighted average. I'm sorry, the value weighted average. The geometric, we went into the financial calculator and brought it down to those 2 shares. So that we were, our 1 to the x was 2, and I brought it down to 0.5. So we were able to do it with that. The only change it to 3. There's 4 companies to 4. We have multiple indexes we looked at. The S&P 500 is the big one that we use most of the examples on. It's the one most commonly known. It is those by market capitalization, the largest companies. Top 500, and when we get to the very bottom, we may have a committee that looks at their liquidity and some other things to decide where those bottom few should be. But the top stuff and our index funds are just looking at probably the top 200 or top 100 because they're going to have an outsized impact on how the S&P 500 moves. Companies on the bottom get a little bit of a boost because of all the people investing in index funds. All those dollars coming through in the mutual funds in retirement plans. We saw our volatility ratio, the volatility index. We even have indexes on the housing market. So different things that allow us to look at the market in a larger sense. Dollar cost averaging was that idea that most people are already doing in their retirement plan, putting aside their 15% every month into whatever investments they've chosen. Dollar cost averaging, until my salary changes, I'm putting the exact same dollar amount aside every month or every 2 weeks, however often you're getting paid. Averaging down, whenever that investment was, that specific one goes down in price, I buy more shares of it. I expect it to go up in the long run. Okay, so gross domestic product, and we had our e-cig. So summing all those together, we had what people are doing personally with their buying. How are they spending their dollars? Where are they going? But just all the dollars spent goes into the consumption. Investments, people putting dollars into the market in whatever type of account. Government spending, are they putting dollars into infrastructure? Where are they spending their dollars and how much dollars are they spending? We saw the idea of deficit or surplus spending. Deficit spending is pretty much what we've been doing, spending dollars we don't have. Net exports, all the stuff leaving the US to go to other countries. CPI was the Consumer Price Index, and we saw that basket of goods along with ways that we could, instead of just looking at, okay, it's gone up 2.1% August 2023 to August 24, that basket of common goods that people get at the grocery store, we can look at overall inflation on different areas, on medical, on all of it together. We could even drill down into a specific state. We have the Federal Reserve, and they have this idea of we want to, and you'll want to know these three things, we want to keep prices stable. We want to, in other words, keep inflation under control. Full employment, if you want a job, you should be able to find a job. So they look at unemployment numbers there. Economic growth, are we continuing to grow the economy? Are we looking at an S&P 500 that last year was at this number and has gone up since? So ideally, we're having growth, people can get jobs, and there's not crazy inflation. I've got monetary and fiscal policy to make this happen. Monetary policy, I can set a reserve for banks to have this much cash on hand, and I can change that to have more or less cash on hand at all times relative to what depositors have. Everybody went to the bank right now and tried to get their dollars out. The bank doesn't physically have all that cash on hand. They've got it linked out to other institutions, to individuals, to businesses, to whatever, or invested in CDs. The discount rate and the Fed funds rates, poorly named. The discount rate is the rate that I charge banks to borrow from me. The Fed funds rate, I am influencing with that. So the Fed funds rate, what banks charge each other to borrow from each other. I want to expand the economy. I want to put dollars in your hands, so I'm buying bonds from you. If I want to contract, I want to slow things down, I'm selling bonds to you. I'm getting dollars out of your hands. Fiscal policy, I can raise or lower taxes. I raise taxes, I'm getting dollars out of your hands. Lower taxes, putting dollars into your hands. I can provide some sort of stimulus. I can provide child care credits, different things that will influence the dollars on your hands, dollars in your hands. My spending, that I start some new infrastructure project to give people jobs, to put dollars out into the economy, or am I cutting back on that stuff? And then debt, am I continuing to deficit spend? What kind of debt levels do I have? All of that is going to impact what my expectations are for the return on my investment. If dollars are easily accessible, the government, the Fed, is trying to expand, grow the economy, I expect companies to be doing really well. So I'm going to expect a greater return. They have easier access to cash, they can invest in new technology, hire more people. It's easier for them to make a profit. And then finally, our behavioral finance. I'll expect you to know 3 of these and be able to explain what it is and what negative harm it might have, how you can fix it as an advisor. For most of these, how you can help clients not fall into one of these is we've got that diversified portfolio that we put together according to their risk tolerance, risk capacity, time horizon, all those things combined to create this portfolio. We don't want to change that plan right now because of any one of these. Overconfidence, I think I know more than I really do. I think all the good things that happened in my investing were because of my brilliance. I'm so much smarter than all these other investors. When in reality, there are experts that have spent years and years studying the markets, getting higher education, and their job is to 40 plus hours a week examine this particular mutual fund, all the assets in it. And I'm expecting that, well, it's okay, I'm smarter than all of them put together, everybody else in the market. I am gonna beat the market and I'm gonna make all this money. The way we control that harm is showing that here's the long run things, all these transaction costs. Overconfidence and illusion of knowledge are both going to potentially inspire more frequent trading. Here's the transaction costs, here's the taxation issues with that. And we had that sandbox that we create for them. So overconfidence, I know more than I do. Illusion of better than all these other investors. Illusion of knowledge, easy to get because we have access to so much information out there, and analysts' advice, whatever they're saying about this stock, this mutual fund, all this stuff is readily available, every publicly traded company. So I think I know more than I actually do. Disposition effect, I fear the pain of losing money on this investment twice as much as the pleasure I'm going to get for gaining money on an investment. Ostrich effect, I'm just going to ignore all this bad news and hope I can spend it however I want. I can invest crazy on it, or house money comes from that idea of in the casino. I came in with $100, I just won $500. Now I can go crazy with that $500. I spend it differently, as if those dollars are different than the ones that I worked all year earning. Familiarity, investing only in areas that I know and am very familiar with. So if I have a diversified portfolio, it's probably not going to be all companies I'm completely familiar with. Mental budgeting can be a good thing. It helps clients figure, okay, I can put this much towards entertainment, towards whatever. But it might also cause harm if we don't clearly track that. I'm just trying to keep track of it all in my head. Cognitive dissonance, having those different beliefs at the same time, what's going on. And other places you'll go. I appreciate you all for being you today. I like you all just the way you are. Any questions on the exam? Yes?
Back one slide, is herding not going to be on
Herding could be, yeah. I know that was yours. I don't take it away from you. I'll still count herding. You had the January effect. So yeah.
December effects.
December, January, yes. No 3 of those. It doesn't have to necessarily be those 8 on the slide. So So we did 10 in classes, there were 10 a year. Whichever ones you choose. That won't count for your something you learned though. You can't pick a fourth one and make that your something interesting I learned that was on the exam. Other questions? Alright, I'll figure out what to do with this mishmash of videos. Roll Tide.